Good morning all. So that was a very nice place for the panel to leave off, talking about the energy efficiency regulations that are now entering into force. I'm going to talk to you about the impacts that we're starting to see on the S&P market. So just a word on VesselsValue. I think most of you probably know who we are. We started in 2011, so we've been going around 12 years or so now. We're a truly global organization, and we specialize and focus on the value of vessels on the S&P market. So we value every vessel that floats every day, and those values are accessible through our digital front end. We also do lots of work around tracking the activity of vessels, and as well as, well, let me just talk through CII briefly. I'm sure all of you are familiar. But basically, vessels in various bands are going to either be forced to take action or may choose to take action in light of the new regulations. So this is just a bit of a diagram to explain what may happen. So you see a vessel in band E would be seeking to get to band C in reasonably short order. A vessel in band C will need to stay there, and a vessel in band B or A, over time, if they don't change their efficiency rating, as the restrictions kind of get tighter over time, they will start to fall through the bands and eventually need a ship energy efficiency improvement plan. So no vessel is immune, I suppose, to these regulations over time. So I think owners and operators have a couple of choices, but ultimately it's going to cost money one way or another to comply with these regulations. So one option is to deploy some capital. So obviously the panel were talking about new vessels. They've also talked about fitting energy-saving devices and alternative fuel types, and it's possible to invest in some journey optimization as well to try and keep that performance or move that performance to a good place. The other option available is to change how the vessel operates, which will impact its earnings. So you could limit the power of the engine, you could reduce the speed, and those two things are obviously interrelated. Or you can select journeys which are optimal for that vessel, but obviously that makes the vessel in question less flexible, which again can impact earnings or make operations more complex. So VesselsValue, as I mentioned at the very start, we value every vessel every day. We also now estimate the CII of every vessel every day as well. We do that via the tracking the vessel's activity via AIS, and then we have a couple of models which convert that into CII ratings using the regulations as described by the IMO. And using our market value model, so our typical market value model considers the type of vessel, the age of the vessel, size of the vessel, the market sentiment, which we use freight rates as a proxy, and the features of that vessel. And that's how we determine the value of a vessel at the very highest level. Now that we're able to determine the CII of every vessel every day, and CII has been published, and everyone's been aware of it for some time, we now have sufficient data to start modelling the impact of CII on the value of that vessel. So we can introduce the CII of that vessel into the value calculations. It's worth noting that our values on our live system do not incorporate CII. This is a piece of active research where we will look to bring in energy efficiency into valuation in the future. So I'm pleased to share with you some initial findings and results. So we see the top left, we've got the three kind of major sectors: bulkers, tankers, and containers, and we have the difference in value when you introduce CII into the valuation calculation by CII band, and this is for 2022 in the top left. So you can see for bands A B, C, and D, there's very little impact. There's no pattern there. But you can see with band E vessels that there is a 5% discount, and that is emerging in real life market transactions. So a vessel in any of those sectors in band E would on average be starting to sell for 5% or so less than vessels performing in the other bands. So this tells you that owners are taking notice, as we've just heard, and these metrics are being factored into S&P decisions. What we have on the bottom left is the chart at the top over time. So you can see this discount for band E vessels has emerged through 21 and 22. Prior to that, there was no discount to speak of. You can also see there was a small premium for band D vessels historically, which has come off. That may be related to earnings. It may be related to vessels going a little bit faster, running with a higher AER in order to generate a little bit more money and therefore being worth a little bit more. But that's come away now. So you can see very clear trends over time in the bottom left, and you can also see not much happening with vessels in bands A, B, and C. So if we move on and start to break this down, we can look at this by age. So I split the fleet into older or younger vessels. I've demarked that at 10 years old. And you can see the discount for younger ships is slightly higher because obviously they have longer of their useful life to run in this regulatory environment. So the impact on those vessels specifically will be higher. And again, we can see that that's being reflected in transactions in the market. And obviously slightly less so in older ships, which are going to spend less time in this regulatory environment. And we can start looking through sectors as well. So obviously we just had the dry bulk panel. So this is the dry bulk view. And you can see here actually there is very little to choose between CII bands in the dry bulk sector. So that obviously tells you that the impacts are higher in other sectors. And it may just be that those effects are yet to kind of start to have the impact in dry bulk. You can also see in the bottom left, over time, there was at some point a discount on band E vessels, and that has gone away during 22, and everything's more or less at parity now. So during this period of time, there was very little influence of CII on vessel values in the dry bulk sector. Moving on to tankers, it's a very different story. So you can see here that tankers in band E had a discount of around 8.5% during 2022. Again, you can see there's not a lot of difference in the other bands. So focus very much on the worst performing vessels. And again, in the bottom left, you can see that pattern has emerged over 21 and 22 as the regulations have been agreed and as the epoch for coming into force approached. So that discount has emerged. And again, you've got a slight premium on band D vessels coming off, which we saw in the summary. And then if we go to the container market, bit of a mixed picture here. But again, there is a discount on band E vessels. Curiously, there's also a discount on band A vessels. It's a little less strong, obviously, than we've seen in the tanker market. So it may be a little bit of noise. I think if you look at the chart in the bottom left, again, it's a bit more of a confused picture, but there does seem to be a discount emerging for band E vessels in the container market. Now, obviously, the last couple of years have been anything but ordinary, so there's a lot of factors at play here. We might, obviously shocks can happen at any time, but we might be over the next year or two, we start to see these effects solidify. So during this analysis, it it struck me that in certain sectors I was dealing with very low sample sizes. And what that means is very few transactions, which obviously is informative in of itself. So taking a look into now, rather than the effect on value, the effect on kind of the volume of sales and purchase, we can see in the top right. So we've got liquidity as the number of vessels sold in a period over the total number of vessels floating. So for example, with band E vessels, if there were 100 in the group, then 5 of them would have sold during the period, because it's at 5% fairly consistently. And you can see that's pretty consistent over time and consistently lower than the liquidity of the other vessels in other CII bands. You can also see in 2021, where there was a bit of a liquidity boom, that the band E vessels did not participate. So this is where we start to see not only is the CII rating of a vessel starting to impact the value of that vessel, it's also then feeding through to the attractiveness and the volumes in the sale and purchase market. And in the bottom right, you can divide that out by age, and you see again that trend is consistent over age. So it doesn't really matter which age you are. You have lower liquidity for band E vessels. Obviously, it's particularly pronounced in the very youngest vessels, as we mentioned before, because they've got so much of their economic life to go within this regulatory environment. And you can see as well the highest liquidity sits with band C vessels around 5 or 10 years old, seen as a relatively safe bet, I would wager. So again, if we can do this by fleet. So if we look at the bulker fleet, again, the effects are more muted. So band E vessels have historically been a little lower on the liquidity side of things, although that is not as pronounced as we've just seen. But again, it's consistent over time, and in fact, there are 0 transactions of band D or E 0 to 5-year-old vessels during this time period. They do exist, they just are not sold. And again, we see very high liquidity in relatively young, relatively well-performing vessels. In the tanker market, again, you can see the effects are more pronounced. So band E vessels consistently low, with liquidity of vessels in band B and C increasing, particularly in 22, as we get closer to the regulations and people really start focusing on the impacts that these regulations are going to have. And again, by age, the effects are consistent and slightly more pronounced with younger vessels. And again, for containers, a similar story to what we saw with the values, where there is some effect, but less pronounced than tankers. And this is particularly where we see the absence of participation in the big liquidity boom there was in 21 during the very high rate period. People were not trading either band E or band A vessels. And I'll get on to why that might be in a moment. But again, and then over by age, older containers in band E actually are holding up reasonably well in terms of liquidity, so are trading reasonably well. I'm guessing because they may well be retired in the wave of the new builds coming to market. So what we've seen there is the measured impact of CII regulation on the S&P market over the last couple of years. You can see there's been a mixed bag by sector, and some of the trends are emerging, and we expect those to start forming. So an important question is, well, if those trends are starting to emerge, where may they end up? Have we, is this it? Have we seen the effects of CII on S&P value, or are we still waiting to see where these numbers might go. So what we're able to do using our both our CII and our valuation models is we're able to run a scenario whereby we move every ship's CII performance from where it is in measured history to the middle of band C. So, and we do that by changing the speed of that vessel, which impacts the earnings of that vessel. So we're moving away from reality now and into a scenario situation. So let's say, I've got a worked example in a second. But basically, as we've heard previously, a vessel slows down, produces less CO2 and improves its AER performance. And this is what we're doing here virtually with the entire fleet. With the lower performing ships, we're also saying, well, what would happen if high performing band A and band B vessels sped up and therefore also operated in the center of band C. So a worked example here, I've got a VL, the Apollo Harmony. This is a screenshot from our platform. In 2022, her CII band was band D. She was, and she was traveling at 13 knots, which was 82% of her rated speed. So in order for that vessel to have operated in band C, she would have had to slow down by 6%. So closer to the sort of 75% relative speed mark. That 6% speed reduction would also then cause a 6% speed in earnings because the vessel is less able to move cargo. And that 6% reduction in speed then follows through to a value reduction of 5%, which in this case is around $3.2 million. So her CII adjusted value would be $59.3 million. So when we apply this to the entire fleet, these are the anticipated trends that we get. So in the top line, we see the observed trends that we saw earlier. So the overall discount for a band E across sectors is around 5%. When you go sector specific, we see there's not a lot of impact in bulkers. There's a fairly sizable discount in tankers, and some pattern is emerging in containers. So the top line is what we observe. The bottom line is the theoretical position, whereby if every vessel changed its speed in order to operate in the center of band C, these are the types of value changes you might expect. So what that means is, across the board, you might expect a 7% premium for a band A rated vessel because she can speed up, move more cargo, earn more money. Whereas you might expect a 13% discount for a band E vessel because she's got to slow down and transport less cargo, earn less money. And again, you can see that by sector. So a 5% spread plus minus in bulkers, a 9% premium for tankers in band A, and a 15% discount, and a 3% spread for containers. So you can see in terms of progress towards the full impact in bulkers, there's some way to go. There's very little impact observed in recent history. In tankers, those trends are emerging but have a little further to go. And in containers, the discount, we wouldn't actually expect to get much wider than it already is. Obviously, the sort of the trend that has not emerged is any premium for a high-performing vessel. So that has yet to, we'll see if that is going to emerge over time. So in summary, we see the biggest impact in terms of both lower values and lower liquidity in the tanker sector. Band E tankers are subject to a value discount of around 8.5% in 2022. And fewer than 5% of band E tankers are traded each year, and that compares to 15% of band B. So liquidity in band E tankers is 3 times lower than those in band B. We're not seeing any impact at the moment in the dry bulk sector, and we're starting to see some impact emerging in the container sector. Obviously, the regulations are still forming, and their true kind of real-world impact is yet to be fully understood. A small speculative discount is being applied to vessels in Band E, which is also then impacting liquidity. No premium has emerged for Band A vessels. However, liquidity is generally a little low. This may be because owners are hesitant to part with their best assets, or it may be they expect a premium which is not currently showing. Liquidity of newer vessels operating in Band D and E is very low, again because they've got so much of their useful economic life to run. And middle-aged vessels operating Bands B, C and D currently, with respect to these regulations, hold the lowest risk and are therefore the most liquid. So people are quite happy to trade these vessels in the open market currently. So that is everything I wanted to run you through today, and I've just seen I've hit time as well. Thanks very much.